Imagine stepping into a world where every financial decision you make is guided by wisdom that has stood the test of time. A world where you no longer chase trends or gamble with your hard-earned money, but instead build wealth steadily and securely. This isn't a dream. It's a reality laid out by Benjamin Graham in The Intelligent Investor. Often called the father of value investing, Graham didn't just write a book about making money. He wrote a roadmap for achieving financial freedom, even in the most unpredictable markets. His principles have shaped the minds of legendary investors, including Warren Buffett, who calls it by far the best book on investing ever written. Graham's insights will transform how you think about money and investing. So get ready to uncover the secrets of long-term success. Invest with a margin of safety. Protect yourself from risky surprises. Imagine you're buying a car worth $20,000. It's been thoroughly inspected, the engine is solid, and it's a dependable ride. Now imagine you're able to buy that same car for $15,000 instead of $20,000. Wouldn't that feel like a win? That $5,000 discount is your margin of safety, a buffer that protects you if unexpected repairs or issues pop up later. In investing, the margin of safety works the same way. It's the practice of buying an investment for less than its true value, known as its intrinsic value. Intrinsic value reflects the company's real worth based on its earnings, assets, and future potential. The larger the gap between the intrinsic value and what you pay, the safer your investment is. Why? Because even if things go wrong, you've got a cushion to absorb the hit. In the 1930s, during the Great Depression, the stock market was in chaos. Many people lost fortunes by overpaying for stocks during the boom years, believing prices would always go up. But some investors avoided disaster because they followed the principle of buying with a margin of safety. They focused on companies whose stock prices had fallen far below their real worth. For instance, take Joe, a cautious investor who had his eye on a factory with assets worth $1 million. When the market crashed, the factory's stock dropped to $500,000, not because the factory was failing, but because everyone was panicking and selling everything. Joe bought shares, knowing the factory's real value hadn't changed. Even if the factory's earnings dipped slightly, he was still safe because he bought it for much less than it was worth. Over time, as the market recovered, Joe's investment paid off handsomely. Why this principle matters. When you invest with a margin of safety, you protect yourself from surprises like market downturns, bad management decisions, or even your own mistakes. If you only buy when the price is far below the true value, you're giving yourself a buffer against risks. Think of it like walking across a bridge with strong guardrails. Even if you stumble, the rails keep you from falling. That's the margin of safety in action. It helps you stay steady, even in rough markets. Understanding intrinsic value, the secret to smarter investing. Imagine you're shopping for a house. Would you buy it just because the seller slapped a for sale sign with an outrageous price on the front lawn? Of course not. You'd want to know what it's actually worth. Things like its location, condition, size, and comparable sales in the area. That's the intrinsic value, the true worth of the house, regardless of the asking price. In investing, it's the same. Intrinsic value is the real value of a stock or security based on the company's fundamentals, like its earnings, assets, and potential for future growth. Knowing this helps you decide if the market price is a good deal or a ripoff. How to find the intrinsic value. Benjamin Graham suggests these steps. 1. Analyze financial statements. Look at the company's earnings, balance sheet, and dividend history. Is it making money consistently? 2. Assess earning power. Can it reliably generate profits in the future? 3. Factor in growth. How likely is the company to grow in the long term? 4. Account for risk. Consider uncertainties like market downturns or competition and adjust your estimate accordingly. During the dot-com bubble of the late 1990s, tech stocks were all the rage. Prices skyrocketed because everyone was buying into the hype, not the reality. Take Techstar, a fictional company with no real earnings but a flashy website. Its stock price shot up to $300 because everyone thought it was the next big thing. Meanwhile, an investor named Sarah ignored the frenzy. She analyzed another company, Solid Tech, that had steady profits, a healthy balance sheet, and reliable growth potential. She calculated its intrinsic value to be $80 per share, but the market was so distracted by Techstar that Solid Tech was trading at $50. Sarah bought Solid Tech, knowing it was undervalued. When the bubble burst, Techstar's stock plummeted to $10, wiping out the savings of speculative investors. But Solid Tech stock slowly climbed to $90, rewarding Sarah for sticking to the fundamentals. Understanding intrinsic value protects you from being swept up by market trends or overpaying for overhyped stocks. Think long-term, the secret to smart investing. Imagine you're planting an apple tree. Would you expect to bear fruit in a week? Of course not. You'd water it, nurture it, and let time do its magic. That's how investing works when you embrace a long-term perspective. It's about planting seeds today and waiting patiently for them to grow. The stock market, like nature, has its seasons. It often reacts to news and trends with wild swings. One day overly optimistic, the next irrationally fearful. Benjamin Graham calls this Mr. Market, a character who offers to buy or sell your stocks at ever-changing prices. Sometimes his prices are absurdly high, other times ridiculously low. A long-term investor doesn't get swayed by Mr. Market's moods. Instead, they focus on the true worth of their investments and act patiently. Investing isn't a sprint. It's a marathon. By embracing a long-term perspective, you can avoid the emotional traps of short-term thinking, weather market storms, and allow your investments to grow steadily over time. Just like an apple tree, success takes patience, but the fruit is worth the wait. Don't put all your eggs in one basket. The power of diversifying your investments. Meet Ravi, a small business owner who invested all his savings in tech stocks during the early 2000s. When the tech bubble burst, his portfolio lost 80% of its value, and Ravi had to start over. Now compare Ravi to Maya, a teacher who followed Graham's advice. Maya divided her savings between stocks, bonds, and real estate. Even within her stock portfolio, she spread her investments across tech, healthcare, and consumer goods companies. When the tech crash hit, Maya's tech stocks dropped too, but her bonds and other stocks held steady. Not only did she avoid major losses, but she was also able to buy more stocks at low prices during the downturn. Over time, Maya's portfolio grew steadily, while Ravi regretted his overconcentration. Why dividend income is a smart investor's best friend. Imagine planting an orchard of fruit trees. Some trees may take years to bear fruit, but what if you could plant a few that consistently produce apples every season? Those reliable fruit trees are like dividend-paying stocks. They provide steady rewards while you wait for your other investments to grow. Benjamin Graham believed that dividends are one of the most reliable ways to build wealth. They're like the financial fruit of your investments, tangible, consistent, and rewarding, regardless of how the stock market is performing. Why dividends matter? 1. Consistent income. 2. Signal of stability. Companies that pay regular dividends show they have strong profits, good cash flow, and disciplined management. 3. A safety net in market turmoil. Even when stock prices drop during tough times, dividends keep coming, giving you a sense of stability and a reason to hold on. 4. Compounding power. If you reinvest your dividends, they can generate even more returns through compounding. Think of dividends as your portfolio's paycheck, steady, reliable, and rewarding. They're proof that your investments are working for you, even when the stock market is unpredictable. By favoring dividend-paying stocks, you're not just investing for tomorrow. You're reaping the benefits today while setting the foundation for long-term growth.